can find a solution for this problem. And then there are chronic conditions or chronic problems. Now, chronic conditions, by contrast, they persist for a long period of time, like asthma or arthritis, when we don't know how to cure them. In this situation, with COVID-19, most people think that this is a chronic condition, that it's a total panic, that you need to sell everything, that the world will never be good again, and so on. But I strongly believe that this is not correct, and that the problems we are facing now are acute, okay, and that they have a solution. Now, for now, we don't have a solution yet, and we don't know how much time it will take to find a solution, a medical solution, maybe a cure or vaccine or something like this, So we don't know if this will take 3 months or 6 months or 1 year or 18 months or 2 years. We don't know that, Maybe there will be some kind of magical solution in 1 month. You never know. Anything can happen. But we will find a way to solve this problem. We will find solutions, because humankind always finds solutions. And this is something we need to understand, that we will find solutions. And people who can keep their heads cool right now and who think long term can have a huge advantage and can turn this recession into a big opportunity. Okay? Let me show this with a very, very interesting story that I heard from a person that you might know, Raymond Aaron. we had a Skype call with Raymond 2 weeks ago, and he told me a story about a big tire graveyard in Canada. I think that it's somewhere near Toronto. There is a small town, and near this town there was this big tire graveyard. I don't remember the name of the town. And there was sorry?
Hagersville, Ontario, and it was a dump site for rubber tires.
Yeah. So Raymond told me this story, and it's really a story that hits home. And you need to understand this story if you want to understand this crisis. When Raymond was starting his career, he was into real estate, and he was buying and selling real estate. So one day there was a big fire at this tire graveyard. So a big fire started to burn. And do you know how a burning rubber smells? Now multiply that by 1 million, and you will get what happened there. So all the people were fleeing the city. It was like a catastrophe, and everybody wanted to get rid of the real estate there. So Raymond went to this city, and he met with a realtor there, and he said, "I want to buy some pieces of real estate." And the realtor said, "Are you crazy? Everybody is fleeing the city, and you want to buy real estate here? Are you crazy?" But Raymond did, and he got a lot of great deals, dirt cheap deals, and he bought some pieces of real estate there. Now, what happened after that? In the next months, the fire was gone, the city was cleaned, and the life returned back to normal. And Raymond was able to sell this real estate for much, much, much higher price. And this story can really give you a good idea of what is happening right now. So when everybody is panicking and everybody is thinking that this is a chronic problem, because also in this city, all the people thought that it's over, that the town is over, and that the life will never be the same again, or they will never be able to live again in this town. But in reality, the problem was acute. Okay, and the same thing goes on in the world today. So this is something that you need to really, really, really understand. Okay, now how to get the best possible returns by understanding these principles. The best way to do it is just to follow my system, especially the part where I talk about long-term investing. So grow your golden goose and my grain system. Now, we all know that we should invest for the long run, for pension, for security, for financial power, to just get great returns for our children, and so on. But there is a big problem when it comes to long-term investing. And that is that the game of investing is rigged. And these guys, the financial advisors, will try to sell you the worst possible investment products. Why? Because they benefit the most from these products and then the companies they work for and so on. So let me show you how this works. And if you understand this, you will understand almost everything about investing. Okay, so this is, pay attention. This part is really crucial for your investment needs in the future. If you want to understand the long-term investing, you first need to understand the key investing principle. The key investing principle is compounding. Okay, compound interest. Now, the boring technical definition says you earn interest or return on your principal and on the accumulated interest of previous periods. So the balance doesn't merely grow, but it grows at an increasing rate. Now, this is theory, okay? But now let's take a look at practice. How does this work in practice? Let's say that you invest $10,000. And let's say that you have 10% annual growth. So 10% was historic annual growth for stocks. So average annual growth for stocks, historic growth, was 10% annually. Now, if you have 10,000, and if this grows by 10%, after the first year, you will have, you probably guessed it right, 11,000. But the next year, it will not be 12,000. It will be a bit more, because also the interest from the previous period was getting compounded, was growing. So it's 12,100 now. And it goes on and on and on. So these numbers start to grow exponentially. And after 40 years, you already have $452,000. All that from a $10,000 investment. So that's times 45. Okay, so this is the power of compounding. And because compounding is such a powerful principle, Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. So let me show you how people who don't understand this principle pay a lot of money because of their ignorance. So let's say that you grow zero, you don't invest. After 5 years, you still have zero. After 20 years, you still have zero, and you won't believe it, but after 40 years, you still have zero. So, if you don't invest, if you don't utilize this most powerful investing principle, you will not earn any money, when investing, because you will not be investing. You will not be utilizing this most powerful investing principle. So let me give you a everyday example. Let's say that you save $5 per day. And I believe that anybody can save if you have a normal paycheck, or if you're a small business owner or whatever, this is like nothing for you. So if you invest just $5 per day, this is approximately $1,825 per year. And if you do that over 40 years, you have invested 73,000 of your money. Okay, $73,000 of your money. But because of the compounding principle and because of the market growth, and I used 9% annual growth here, okay, so I didn't go with 10% like it was historic growth for stocks. I went with 9. You got amazingly $657,000 just in returns. So your pension pot is $730,000. So this means that if you are not investing, you are basically leaving all that money on the table. So $657,000 on the table. And this is the cost of not investing for the long run. In other words, small investments can make you wealthy if you start now. There is a Japanese proverb that says, when is the best time to grow a tree? And the answer is 10 years ago. But if you haven't done that 10 years ago, the next best time is right now. So you should start invest right now. And of course, 2020 will probably be one of the biggest investment opportunities in our lifetime. Simple as that, because the market went down it went down in such an aggressive move, and probably it will go down even further. Okay, it will go down even further because in the next year, as you can see, the economy is at a standstill, and companies are firing people. So it will be a very, very big recession. But like I said, we will get over it. We will survive this recession, and we will be stronger after this recession. And people who started to invest during 2020 will probably be the biggest winners of this period. So, how to invest properly? What kind of financial products to use? Which asset categories to use for investing? Let's take a look at the grain system. The first letter in the system is grow the right assets. Because if you don't grow the right assets, it's game over from the start. Okay? So the big question is, what to invest in? What are the best financial products? So let's take a look. What are the options? So what are the options for long-term passive investments? Okay, and here I'm talking only about passive investments. I'm not talking about active investments like investing in your own business or investing in real estate, because these two types of investments are active investments where you need to work hard to make some money out of them. Okay, so now we are talking about money working for you passively. So what are the options? The first option are stocks. You are basically investing in companies. When you buy a stock, you become a co-owner of a certain company. Then bonds. Bonds, like government bonds. You just two things about bonds. If you don't know what this product is, just keep in mind that first, it's very safe. So you just lend some money to the government. And the government then gives you some interest because because they borrowed your money. So it's very secure but very low returns. Okay, so bonds are very secure but they give you very low returns, maybe in a region of 2-3% per year. Then precious metals, gold, silver. Then you can keep your money under bank deposits. So the next one is bank deposits. And the last one is keep your money under the mattress. Okay, so these are the options. And now, what are the best options? But in order to get to the best options, we first need to eliminate some really, really bad options. So which options are the worst? Let's take a look. The first is keeping your money under the mattress. Now, this is okay if you keep your money under the mattress for maybe a short time period, for a couple of months, for maybe 1 year. And in this situation, it's not a bad idea to have some money in cash. And I have some money in cash because I'm waiting for the right opportunities now. So, for short time periods, keeping your money under the mattress is a good idea. But when it comes to long time period, like 4 years, 5 years, 10 years, it's a big no-no. Why? Because of the inflation. Prices are going up all the time. And if you keep your money under the mattress for 10 years, your money will lose approximately 1/4 of the purchasing power. Okay? So in other words, prices will go up by 25% in 10 years. So your money will be worth less and less. And in 2 decades, you will only have half of the purchasing power that you have today. So it's not smart to keep your money under the mattress. The second worst option, you've probably guessed it, it's bank deposits. Banks give you almost nothing in interest right now. So you are still losing money accounting for inflation. So when you account for inflation, you are still losing purchasing power. What about precious metals? Good or bad? Most people say, hey, great option. But unfortunately, they are mistaken. Why? Because precious metals, historically, they produced worse returns than bonds. They just kept their value with the inflation and just a bit more. So the average returns, long-term returns, average annual returns for gold and silver were just around 2% annually. So would you be happy with 2% annually? Okay, so I'm not using gold when I want to get great returns. I'm just using gold in my system in the second part, protect yourself. Okay, so if gold, we are just using it in the second part for financial protection, but we don't expect huge gains from gold. And this is something that a lot of people don't understand, and it's very important. And now only stocks and bonds are left. And these were historically the most profitable options. Now, which one produced better returns? You probably guessed it, stocks. Stocks are more volatile, but also they produced much higher returns in the past. This is one of the most important charts when it comes to investing. This is the chart of real returns after inflation returns for different asset categories in the past. So this is from 1926 to 2016, okay? Almost 100-year period. And as you can see here, only stocks, the blue line, produced huge returns, and everything else was pretty average or miserable, okay? So only stocks produced amazing returns in the past. And this is not like a bit better returns compared to bonds or gold. But Robert,
we can't see the graph.
You cannot see what?
We can't see the graph. We just see, there it is. Thank you.
Maybe it's our screen.
Yeah, okay. Now you see it? Yeah, okay. So the important thing is that this difference is not small. It's huge difference. It's like 40 or 50 times better returns compared to everything else. Okay? So why were stocks historically such a good option? And the reason is because stocks are companies. When you invest in stocks, you are investing in the most dynamic part of our world. You are investing in companies that are innovating all the time, that are producing new value, bringing new value to the market, they are adapting to market conditions, and so on. That is why companies produced the best possible returns in the past. Now, will it be the same in the future? And my answer is, you never know. Nothing is 100%, okay? You need to be very careful when it comes to investing, because nothing is 100% sure. So, if the world will survive, if the aliens don't invade, if there is no global catastrophe, and we all die, then companies will continue to produce the best possible returns, okay? So it's like 99% chance or probability that the same will happen in the future. But of course, there is always 1% probability that maybe something really strange will happen and we will all die in the big laser blast from the alien spaceship or something, So we need to understand these probabilities. So stocks were the best option in the past, and 99% probability is that there will be the best possible option also in the future, okay? Because they are growing, they are adapting themselves, and they are bringing new value and so on. So most of our long-term portfolio will probably be in stocks, okay? It depends on your age, of course, because if you are 70 years old, it will be a bit different, okay? Because you will need to have a lot of money in bonds also. But if you are younger, then you will probably have the biggest part of your portfolio in stocks. I have most of my money in stocks and now in cash because I'm waiting for the right opportunities. Now, let's pick some stocks. Let's pick Apple, let's pick Amazon, let's pick Tesla, let's pick Nike, Disney, and so on. Is this a good choice? And the answer is no. Even though these companies are great, it's not a wise choice. Why? The reason is because any company can go down or out of business. Let me give you a famous example. Do you remember a company called Nokia? 12 years ago, Nokia was the leader in the mobile phones. But today, they are nowhere. Their stock fell by 97%. So 12 years ago, Nokia was just like Apple today, but now it's almost gone. So that is why it's very risky to invest in individual stocks, and you should never do it. I don't invest in individual stocks. I never invest in individual stocks, and I never will. It's like gambling with your money. But, of course, when you invest in the whole stock market, then it's another thing, and I will explain this in a minute. So, the second reason why we don't invest in individual stocks is that nobody can pick just the right stocks. Stock market analysts and gurus are famous for their predictions that are wrong. David Dreman did a big study of stock expert predictions, and he found out that they were historically wrong in 77% of cases. So it would be much better if you listen to them and just do the opposite, okay? So that is why we never invest in individual stocks. But like I said, if you invest in a big basket of stocks, then you can be pretty sure, it's never 100%, but you can be pretty sure that these stocks will grow over time, because you are not investing in individual stocks, but in a whole stock market. And because the financial industry found out that people are afraid of investing in individual stocks, they proposed a solution. Decades ago, they proposed a solution. And the solution was mutual fund. So when investing in mutual funds, and this is the most popular investing product all around the world, also in Canada. So if you invest in mutual fund, you are basically investing in a big basket of stocks. And that's a great idea. That's a great idea because you are lowering the risk. You are lowering the risk. You are not investing in individual stocks. But why did I tell you that that investing in mutual funds is one of the worst ideas that you can get, and that this will destroy your financial future? And the reason is because of the small details. The devil is always in the details. So let me show you the most important thing that you need to understand about all long-term investments. Okay? And if you are investing, like most people do, in mutual funds or in whole life insurance, this is the type of life insurance where you invest something and you are also insured for life. So it builds cash value. So these two products are the worst possible products: mutual funds and whole life insurance. And now I will show you why. So pay attention. When you invest in mutual fund or whole life insurance, first you pay a sales fee or entry commission. Then you pay when you want to exit. Let's say after 10 years, you want to exit this product, you pay exit fee. And these two fees are approximately 0 to 3%. Okay? Depends on the product, but 0 to 3%. But I have some good news for you. And these good news are that these two fees are not important. Why? Because they are just one-time fees. Okay? And they will not affect your long-term returns by much. But there is another fee that can wreak havoc in your investment account. And this fee is management fee, or total expense ratio, or expense ratio. This fee is deducted from your account every single year. For as long as you are in this product, this fee is being deducted every single year. Okay? And on average, it's around 2 to 2.5% annually. And now you will say, but Robert, that's not a lot. You know, they take 2% and I keep 98. That's perfectly okay. Right? Wrong. Wrong. Why is that wrong? What did we forget to account for? We forgot to account for compounding principle. And I call this the dark side of compounding. Not only your returns are getting compounded when you invest, but also the commissions are getting compounded. So that is why I call this the dark side of compounding. Now let me show you this, the dark side of compounding, the effect of this in the previous example. So if there were no fees, you would, by investing $5 per day, you would just have the entire pension pot for yourself, $730,000. But when you account for the 2% management fee, this will not amount to $730,000, but the biggest part of the pie will be eaten by the financial industry. So you will only be left with $350,000, and the majority of your money will be taken by the financial industry through small commissions and fees. So this is really something that nobody in the financial industry will ever tell you about. Why? Because it's not in their interest. Because they make a lot of money when you don't know these things. Okay? So small fees can basically halve your long-term returns. Small fees can halve your long-term returns. Now, is this a good thing? For the financial industry, it's perfect. But for us, it's a really bad thing. So, would you like to learn the solution? If your answer is yes, then here is the solution. Instead of investing in mutual funds, yes. I used to invest in mutual funds when I was younger and I didn't know these details. But right now, I'm investing in a different product, much better product. It's called the index fund. Simplified. Index fund is just a very similar product to a mutual fund, but with much lower commissions and fees. The expense ratio or management fee for mutual funds is 2 to 2.5% annually, but for index funds is just 0.05 to 0.5% annually. So approximately 10 times lower commissions and fees, okay? And this is key. So when investing in index funds, you keep the lion's share of all the returns. So let's take a look at the previous example. So here, when it comes to mutual funds, the financial industry would take all that money through these small commissions and fees. But when you invest in index funds, the financial industry will keep or take just a small portion of your money. And the lion's share will be yours. So that is why I love to invest in index funds. Let me give you a real life example. So this is comparison between two funds. The blue line is one of the most popular mutual funds. It's called Fidelity Magellan. Okay, it's one of the most popular mutual funds in the world. And the red line is one of the most common, or one of the average index funds. It's called SPY, and it just follows the S&P 500 index. So the biggest United States companies. And why did I choose these two for comparison? Because they are both investing in the same basket of stocks. Okay, because you cannot compare, for example, pharmaceutical mutual fund to a technology index fund. This is like comparing apples and oranges or bananas, So you need to compare something very similar, something that invests, so two products that invest in the same stocks. And here we are comparing two products that are investing in basically the same stocks. There is 95% stock overlap here. And as you can see, the ups and downs come at exactly the same times. But the difference is huge. So if you invested 10,000 in both products a couple of decades ago, now you would have 14,000 if you invested in mutual fund. But if you just chose a better investment vehicle, index fund, you would now have $61,000. A bit of a difference, huh? So this is the difference between mutual funds and index funds. And the same goes with whole life insurance, but it's even worse for the whole life insurance, okay? Because they have additional fees on top of the mutual fund fees there. And as you can see here, the difference between these two funds is growing larger and larger. Why? The first reason is because of the difference in fees. And the second reason is because of compounding principle. Because the longer you keep this investment, the bigger the difference, okay? And all the difference is basically the difference in commissions compounded. That is why also Warren Buffett is a very big advocate of index funds, just like me. Okay, so today we learned about the first letter in the grain system. What to invest in. But of course, if you want to really invest the right way for the long run, and if you want to really get the maximum profits, you need to understand a couple of other things. You need to understand the other letters also. The most important thing is that there are more than 4,000 index funds available all around the world. And most of them are not a good choice for long-term investors. A lot of them are short-term trading vehicles. A lot of them have higher fees. They have similar fees to mutual funds. The financial industry is very cunning. They just name something index fund, and you think you are buying index fund, but then you take a look at the commissions, and they are very similar to mutual funds. So you need to really know what to choose. You need to know which index funds are the best. And that is why, because this is a very difficult task, I did something for my clients. And this is that I prepared my personal selection of 14 index funds that are the best of the best. They have the lowest possible fees, they are suitable for long-term investors, and they have the highest profit potentials. Because there are certain industries that are already mature industries, or they are already, going down. So we don't like to invest in this kind of industries. And the same goes with different markets, different regions. We don't invest in regions that have no potential. So I made this important selection for you. I spent more than 100 hours analyzing different regions, different industries, different index funds, and I created this list for you. And all of the index funds that I personally invest in are on this list. Okay, so you get the solution, you get the names, you get everything here. And then you will not invest in all 14 of them. I only invest in 6 of them. So you will maybe invest in 1, 2, 3, 4, 5, 6 of them, not in all 14. That is why I will give you my satellite strategy. So this will help you to choose the ones that you will personally invest in. Okay, and you will see it's simple and easy, and it's a bit different if you depending on your age and depending on your goals. Okay, but this strategy will give you the solution. It will give you the one that you will invest in. And at the end, I will also explain how to invest in index funds. I will explain which brokers to use in order to invest in index funds. So which brokers are the best. I have a special selection also for Canadian market, for US market, for European market, for UK market, and so on. And when to invest. And this is really an important thing. When to invest now, in the next year, there will be huge opportunities. And as you will see later, I update my clients about this. So when you invest in index funds, the best companies in the world are working for you in a passive way. So this is a passive investment vehicle, and you can use it in order to get the best possible